Welcome to Being Financially. When it comes to growing your wealth, in today's dynamic economic landscape, opportunities abound in areas like private equity, venture capital, and fractional assets. Private equity, once the domain of institutional investors, is now accessible to individuals like never before. By investing in private companies, you can potentially reap the benefits of their growth and success, often unseen in public markets. This avenue offers the chance to be part of groundbreaking innovations and disruptive technologies that could shape the future. Venture capital is another enticing option for those seeking high growth opportunities. By investing in early stage companies with significant potential, you not only stand to make substantial returns, but also contribute to fostering entrepreneurship and innovation. This sector has the power to transform industries and create immense wealth for investors. Fractional assets have emerged as a game changer for those looking to diversify their investment portfolios. By owning a fraction of high-value assets, such as real estate, art, or collectibles, you can enjoy the benefits of ownership without the hefty price tag. This allows for greater diversification and risk mitigation, crucial in today's unpredictable market environment. Why does this matter now? Inflation is on the rise, eroding the purchasing power of your money. Volatility in traditional markets makes diversification a necessity, not a luxury. People are seeking alternative investment strategies to safeguard and grow their wealth in the face of uncertainty. So as you navigate the financial landscape of 2025, remember that the stock market isn't the only place to grow your wealth. Explore the opportunities in private equity, venture capital, and fractional assets to secure your financial future and thrive in the ever-evolving world of investments. Alternative investments are assets that are not traditional stocks, bonds, or cash. These can include a wide range of unique investment opportunities that may offer higher returns, but also come with higher risks. Some common examples of alternative investments are private equity, venture capital, and fractional assets. Private equity involves investing in privately held companies that are not listed on a public stock exchange. Investors typically pool their funds together to acquire a stake in a company with the goal of growing it and eventually selling it for a profit. Private equity investments are known for their potential to generate high returns, but also require a longer investment horizon. Venture capital (VC) is a type of private equity investment that focuses on early-stage companies with high growth potential. VC firms provide funding to startups in exchange for equity ownership. These investments are high risk, but can offer substantial rewards if the startup becomes successful. Fractional assets are another type of alternative investment that allows investors to own a fraction of a high-value asset, such as real estate, art, or collectibles. This enables investors to diversify their portfolios and access investments that may have otherwise been out of reach. In summary, alternative investments offer investors the opportunity to diversify their portfolios and potentially achieve higher returns than traditional asset classes. However, it is important to understand the risks involved and conduct thorough research before investing in these non-traditional assets. Private equity is often confused with stocks, but they are fundamentally different investment vehicles. While both offer the potential for financial growth, private equity stands apart in several key ways. One of the primary advantages of private equity is its higher return potential. Unlike stocks, which are publicly traded and subject to market fluctuations, private equity investments are made in privately held companies. This can lead to greater growth opportunities and therefore potentially higher returns for investors. Another benefit of private equity is portfolio diversification. By including private equity investments in a portfolio alongside traditional stocks and bonds, investors can spread their risk and potentially increase their overall return. This diversification can help navigate market volatility and economic uncertainty. However, it's important to consider the drawbacks of private equity as well. One major downside is the illiquid nature of these investments. Unlike stocks, which can be bought and sold on public exchanges, private equity investments are not easily tradable. This lack of liquidity means that investors may not be able to access their funds quickly in case of unexpected financial needs. Additionally, private equity investments often come with high minimum investment requirements. This can be a barrier for smaller investors. looking to diversify their portfolio with private equity. In conclusion, private equity offers unique advantages such as higher return potential and portfolio diversification. However, it's important to carefully consider the drawbacks of illiquidity and high minimums before investing in this asset class. By understanding the differences between private equity and stocks, investors can make informed decisions to help achieve their financial goals. Venture capital explained. Venture capital, or VC, plays a crucial role in funding startups. Essentially, venture capitalists are investors who provide funding to early-stage companies in exchange for equity ownership. This means that they take on a high level of risk in the hopes of achieving substantial returns in the future. Venture capital is considered a high-risk, high-reward investment for a few key reasons. First and foremost, startups are inherently risky ventures with a high rate of failure. Many new companies fail to gain traction in the market or run out of funds before they can turn a profit. As a result, venture capitalists must be willing to accept that their investment may not pay off. On the other hand, successful investments in startups can yield enormous returns. Companies like Uber and Airbnb, for example, started with venture capital funding and have since grown into billion-dollar businesses. For venture capitalists, the potential for such high returns is a major draw, outweighing the risks involved. Overall, venture capital plays a vital role in fueling innovation and entrepreneurship. By providing funding to promising startups, venture capitalists help drive economic growth and create new opportunities for both investors and entrepreneurs. While the risk may be high, the potential rewards make venture capital an attractive investment option for those willing to take a chance on the next big idea. Have you ever dreamt of owning a rare piece of art, a luxurious property, or a coveted collectible, but the price tag seemed out of reach? Well, now you can with the rise of fractional asset ownership. Fractional asset ownership allows investors to purchase a share of these high-value assets, giving them access to a piece of the pie without needing to buy the whole thing. Platforms like Masterworks, Rally, and Arrived are making it easier than ever for individuals to invest in fractional assets, offering a unique opportunity to diversify their portfolios. One of the main advantages of fractional asset ownership is the lower barrier to entry. Instead of needing to come up with the full purchase price of an expensive asset, investors can now buy a fraction of it, making it more accessible to a wider range of people. This opens up opportunities for individuals who may not have been able to invest in these assets otherwise. Additionally, fractional asset ownership allows for greater diversification. By investing in multiple fractional assets, investors can spread their risk across a variety of different assets rather than putting all their eggs in one basket. This can help protect against market fluctuations and potentially increase overall returns. So, if you've ever wanted to own a piece of a valuable asset, but thought it was out of reach, think again. With fractional asset ownership, you can now invest in high-value assets with a lower barrier to entry and greater diversification. Explore the rising platforms like Masterworks, Rally, and Arrive to start your fractional asset journey today. If you're looking to get started in investing, follow these 4 crucial steps to set yourself up for success. First and foremost, determine your risk tolerance. Understanding how much risk you are willing to take on will help guide your investment decisions and prevent you from making choices that are too aggressive or too conservative for your comfort level. Next, research platforms and minimums. Different investment platforms have varying levels of accessibility, fees, and minimum investment requirements. Find one that aligns with your goals and financial situation to ensure a smooth start to your investing journey. Once you've chosen a platform, it's time to diversify across different assets. Spreading your investments across a variety of assets such as stocks, bonds, and real estate can help mitigate risk and optimize returns. Avoid putting all your eggs in one basket by diversifying wisely. Lastly, remember to monitor and reassess regularly. Keep track of your investment's performance and make adjustments as needed based on market conditions and changes in your financial goals. Regularly reassessing your portfolio will help you stay on track and make informed decisions for your financial future. By following these steps, you can get started on the right foot with your investing journey and work towards achieving your financial goals. Are you looking to get started with investing, but not sure where to begin? Here are some clear steps to help you get started on the right track. First, determine your risk tolerance. This is an important step in understanding how much risk you are comfortable with when it comes to investing. By assessing your risk tolerance, you can make informed decisions about the types of investments that are suitable for you. Next, research platforms and minimums. There are many different platforms available for investing, each with their own minimum investment requirements. Take the time to research and compare these platforms to find one that aligns with your investment goals and budget. Once you have selected a platform, it's important to diversify across different assets. Diversification can help minimize risk by spreading your investments across various asset classes such as stocks, bonds, and real estate. This can help protect your portfolio from fluctuations in any one market. Finally, monitor and reassess regularly. Investing is not a one-time event. It requires ongoing attention and monitoring. Regularly review your investments and make adjustments as needed based on changes in your financial situation or market conditions. By following these clear steps, you can feel confident and empowered to get started with investing. Remember to always seek guidance from a financial advisor and do thorough research before making any investment decisions to ensure the best possible outcomes for your financial future. In conclusion, we have covered a number of key points that are essential for growing your portfolio. In 2025, we discussed the importance of diversification, the potential of emerging markets, the impact of technological advancements, and the significance of staying informed and adaptable in an ever-changing market. Diversification is crucial for spreading risk and maximizing potential returns. Investing in emerging markets can offer unique opportunities for growth and expansion. Embracing new technologies and innovation can lead to significant advancements in your portfolio. Finally, staying informed and adaptable will allow you to adjust to market trends and make strategic investment decisions. Our key takeaway is that in order to grow your portfolio in 2025, it is important to consider all of these factors and be open to new opportunities. By integrating these strategies into your investment approach, you can position yourself for success in the years to come. If you want to learn more strategies to grow your portfolio in 2025, subscribe now. We will provide you with valuable insights and expert advice to help you navigate the evolving financial landscape and make the most of your investments. Don't miss out on this opportunity to take your portfolio to the next level. Subscribe now and stay ahead of the game.